$142.50? That's what showed up in my brokerage account last Tuesday morning. Dividend paid. And I felt that thing. You know the thing. That warm little hit of free money. I didn't sell anything. I didn't do anything. The market just mailed me a check for owning a slice of a company while I was asleep. So I opened the app to see my new slightly richer total, and it was exactly the same as the day before. Not a penny more. If anything, a little less. So where did the $142 come from? Not the sky. Not the company being generous. It came from any. The market quietly took it out of the value of my own shares, handed it back as cash, and somehow got me to feel grateful for it. Here's my bet for the next 10 minutes. I'm going to take away every reason you have for loving dividends. And you've got exactly 5. You don't know you're holding them yet, but the second I start pulling, your brain reaches for them in order. But it's free money. But it feels different. But I just reinvest it. But I'll buy the high yields. But this doesn't apply to me? 5 excuses. I'm knocking down all 5. Let's go. The reflex. It's free money. The company is paying me for owning the stock. Let me show you the exact moment that falls apart. There's a day called the Ex-Dividend date. Most people think it's boring paperwork. It's the whole trick. Exposed. A stock trades at $50 and the company's about to pay a $1 dividend. The day before it closes at $50. The next morning, before any news, before anyone buys or sells, it opens at $49. It just drops by almost exactly the dividend. The exchange adjusts it down on purpose. Why? The company's about to ship $1 per share of its own cash out the door. That cash was inside the business, part of what made each share worth $50. Now it's gone, so each share is worth $1 less. The money didn't multiply, it moved from the company pocket to your bank account pocket. Both pockets are yours. Concrete version, you own 100 shares at $20 each. That's $2,000. The company pays a $1 dividend, 100 in cash. Feels great. But your shares drop to 19. So now, 1,900 in stock plus 100 in cash. $2,000. Exactly where you started. Now a second investor, same 2,000, but no dividend. They want $100, so they sell 5 shares. 95 shares left, worth 1,900 plus 100 cash. 2,000, same place. There's even a name for that move, a homemade dividend. You can make your own anytime by selling a sliver. The market doesn't care what you chose. So my $142, the market sold $142 of my own stock for me without asking and handed me the cash. Not a gift. A mandatory withdrawal from my own account. Defense 1, gone, and I know what you're about to say next. Because I said it too. I don't even spend mine. I reinvest every penny, so none of this matters to me. The reinvestment is the proof. Watch what auto reinvesting actually does. The cash comes out of your investments and a second later buys more shares of the same fund. Out the door, back in the window. A full round trip. If dividends were truly extra free money, reinvesting would be insane. You'd refuse free cash to buy what you already own. But it's totally normal because there was never free money. Only your money moving in a circle. You just proved my point for me. And that round trip isn't free. In a taxable account, the moment a dividend lands, it's a taxable event. You owe tax this year, whether you wanted the cash or not, spent it or reinvested it. Nobody asked you. Compare the homemade dividend investor selling shares, only the profit gets taxed, not the whole amount. And they pick the moment. They can wait, sell in a low-income year, or sell losers to erase the tax. The dividend investor gets none of that. And before the tax nerds start typing, yes, a qualified dividend gets the lower rate. But a lower rate on a tax bill you never had to trigger is still a tax bill you never had to trigger. Money you handed the government this year instead of letting it keep compounding. So if you just reinvest anyway, you paid a tax bill today to move your own money in a circle. Pure drag for nothing. Defense 3, gone. Which is when people stop defending and go on offense. If a dividend's just my own money coming back, I'll grab the biggest one I can find, 8%, 10. More yield, more income. This is the one that destroys people. 2 graveyards. First, how yield works. Annual dividend divided by share price. So a yield can spike for 2 opposite reasons. 1, the company raised its dividend, great. 2, the price collapsed because the business is dying, which makes the old dividend look huge next to the wreckage. That's a yield trap, and it looks most attractive exactly when it's most dangerous. Meet General Electric. For a century, GE was the blue chip, a Dow member, the stock millions of retirees held for safe dividend income. If safe dividend had a face, it was GE. Then the business cracked. November 2017, they cut the dividend in half, 24 cents to 12. Half a paycheck, gone. A year later, 2018. they cut again to 1 cent. From 24 cents to a penny, the stock lost about 80%. A whole generation of safe income investors wiped out, holding the bluest chip in America. GE's the sad story. AT&T's the trap. They'd raised their dividend every single year for 35 years. A dividend aristocrat. Retiree gospel. In 2022, they cut it nearly in half, 52 cents to about 28. Here's the detail to never forget. When they announced it, the stock dropped, and because the price dropped, the yield went up, past 7%. So every screen and income investor hunting for the highest yields saw AT&T getting gutted in real time become more attractive. The bait got shinier as the trap closed. People bought more on the way down. So that warm feeling left unsupervised doesn't just cost you tax, it walks you, smiling, into the most fragile companies on the market because they're fragile. The higher the yield, the louder the warning, and the better it feels to ignore it. Defense 4, gone. One left, the one you've been telling yourself this whole time. Interesting, but I don't pick dividend stocks. I just buy index funds. Not about me. It's completely about you. If you own an S&P 500 fund, a total market fund, basically anything in your 401k or IRA, you're getting dividends right now. Apple, Microsoft, JP Morgan, ExxonMobil, Coca-Cola, hundreds of them mail out cash every quarter and a slice flows into your fund whether you look at it or not. You already live inside this system. The only question is whether you understand it. And that round trip, it's happening in your retirement account, on autopilot 4 times a year, probably without you ever noticing. Your money running in a circle forever, which kills the biggest fantasy on finance YouTube. Live off your dividends, never touch the principal. A fairy tale. Every dividend you live off already came out of your principal. The price dropped to pay it. There's no wall between the income and the nest egg. It was always one pile. The only number that was ever real is your total return. Price change plus dividends. Everything else is just which drawer your brain filed it in. That's all 5. Gone. So are dividends a scam you should hate? No. There's a real case on the other side, and it's built on the psychology, not against it. Yes, the warm feeling is irrational, but so is panic selling your whole portfolio in a crash. And a lot of dividend investors don't, precisely because that quarterly check keeps them calm and invested for decades. If a slightly irrational feeling stops a catastrophically irrational decision, it just paid for itself 100 times over. There's nothing dumb about using your own psychology as a tool, as long as you know that's what you're doing. But the bear case is the whole video. A dividend isn't free money. It's a withdrawal from your own account that the market makes for you, and that your brain is wired to never notice. It can cost you taxes you never agreed to, and the feeling, off the leash, leads you straight into the next GE, the next AT&T. So, dividends aren't the enemy. Believing they're free money is next time that dividend paid notification lights up your phone and you feel that warm little glow, I'm not asking you to stop enjoying it. I'm just asking you to remember where the money came from. It came from you. It was always coming from you. If you want to understand what's quietly happening to your money, the tricks so normal nobody bothers to explain them, subscribe. I'll see you in the next one.